In 1918, World War I ended, and the U.S. entered a period of massive economic growth. Soldiers returned home, women had entered the workforce in large numbers, and a rush of new wealth fueled the parties and jazz music of the Roaring '20s. At the same time in Detroit, Henry Ford implemented the moving assembly line. This manufacturing technique slashed the price of a Model T from $780 down to $290, making it affordable for the average family. Soon, companies across the country copied this process to mass-produce radios, washing machines, and vacuums. To keep up with the exploding demand for all these new products, banks began giving out loans freely. For the first time, average people could buy consumer goods on credit, using money they hadn't actually earned yet. People were celebrating, and the economy looked invincible. But underneath the spending, this sudden wave of prosperity was an illusion, propped up by a rapidly accumulating mountain of consumer debt. This chart shows how that credit frenzy eventually spilled onto Wall Street through a practice called margin buying. Instead of paying full price for a stock, investors could buy shares by putting down as little as 10% in cash, while taking out a bank loan for the rest. Pushed upward by these massive loan blocks, the stock market skyrocketed sixfold during the 1920s. Extreme greed set in. As the stock line surged higher and higher, almost no one noticed that real economic demand for actual goods, in Europe and at home, was quietly stalling out below. The fantasy broke in October 1929. Across 2 days, known as Black Thursday and Black Tuesday, investors panicked, selling off tens of millions of shares. In just 2 weeks, the stock market lost a third of its value, wiping out heavily leveraged investors. But stock markets experience severe corrections and crashes frequently throughout history. Usually, the economy recovers within a few years. So why did this specific crash drag the globe into a 10-year economic nightmare? The 1929 crash served as a high-speed trigger, rapidly exposing a deep, systemic rot that had been quietly eating away at the American banking system. At the time, the United States was filled with thousands of small, independent local banks. Without heavy oversight, many of these banks had taken the cash deposited by their local communities and recklessly gambled it on stock market speculation. When the stock market crashed, those banks became insolvent overnight. And because there was no deposit insurance, meaning the government didn't guarantee your savings if a bank failed, when a local branch closed, the life savings of everyday citizens simply vanished. This sparked widespread panic. In New York City, a single false rumor that the Bank of the United States refused to sell a man's stock led to 25,000 people crowding the street. They desperately pulled $3 million out of the bank in a single day, destroying the institution completely. Seeing major institutions fail, terrified citizens across the country rushed to pull their cash out of healthy banks too. These massive bank runs drained the entire financial system of liquidity, causing 1/3 of all banks in America to eventually collapse. Pure, contagious fear drove millions to empty their accounts, transforming a localized crisis on Wall Street into a catastrophic collapse on Main Street. This graphic shows the destructive cycle of deflation. With people hoarding cash in their mattresses instead of banks, the U.S. money supply shrank by 31%. Deflation means money becomes more valuable over time, which causes prices and wages to drop, but makes existing debt burdens drastically heavier and harder to pay off. As this financial strangulation happened, the Federal Reserve stood back. They allowed the massive money supply contraction and thousands of banking failures to occur without intervening. Meanwhile, President Herbert Hoover attempted to protect American farmers and industries from foreign competition by signing the Smoot-Hawley Tariff Act, increasing taxes on foreign imports by roughly 20%. The policy backfired immediately. 25 different countries retaliated with their own tariffs on American goods. As a result, global trade plummeted by 66%, cutting off a vital source of revenue right when the country needed it most. As if the collapsing banks and trade wars weren't enough, the American agricultural sector was decimated by the Dust Bowl. A period of severe drought, combined with overfarming, created massive dust storms that ruined crops and displaced millions of rural workers. A shrinking money supply, the Federal Reserve's refusal to intervene, and the breakdown of global trade combined to cement the depression for the decade to come. By 1932, the country hit rock bottom. Unemployment reached nearly 25%. Over 34 million people were left without any income whatsoever, forcing families into sprawling, makeshift shantytowns that citizens bitterly nicknamed Hoovervilles. Able-bodied men who had helped build the industrial boom of the 1920s were now reduced to standing in massive lines just to receive basic rations of food. Demanding drastic action, the public overwhelmingly elected President Franklin D. Roosevelt. He rolled out his New Deal programs, establishing minimum wages, unemployment insurance, and heavy public works projects. More importantly, he targeted the structural rot. Roosevelt created the Federal Deposit Insurance Corporation, the FDIC, to insure bank deposits and prevent future bank runs. He also established the Securities and Exchange Commission to force public companies into honest reporting and to restrict blind speculation. While FDR's sweeping reforms successfully restored public confidence and stopped the immediate panic, these policies alone couldn't fully pull the American economy out of its deep 10-year trench. It wasn't until 1939 that the Depression truly broke. The massive surge of industrial manufacturing and government stimulus required to support the outbreak of World War II finally drove the unemployment rate back below 10%. Today, we manage our economies quite differently. The tools we rely on, a stable, targeted rate of inflation, government intervention during downturns, and federally insured banks, were born directly from the ashes of this era. These systemic guardrails are built into modern finance entirely because society learned the hard way what happens when underlying fragility is left unchecked. The ultimate lesson of the Great Depression is not the inevitability of a market crash, but the catastrophic cost of systemic failure and government inaction.